Imagine waking up in an apartment complex built by one specific family. You check a smartphone manufactured by that same family, drive to work in a vehicle they engineered, and stop to buy groceries at a supermarket they own. If you get sick, you go to their hospital. If you want to take a vacation, you stay at their hotels and ride their theme park attractions. For a lot of people in the West, having one single corporate entity touch every single aspect of your daily life might sound a bit like a sci-fi movie. But in many parts of Asia, this isn't fiction. It's just daily life. The economic growth of Asia over the last few decades has been called a miracle. But that miracle wasn't just built by abstract government policies or faceless multinational corporations. It was built by families. And the scale of how these families operate is something that fundamentally challenges how we understand modern capitalism. But how exactly did a handful of family trees grow to essentially encompass entire national economies? And more importantly, as we look at the data today, what happens to these countries when the families running them start to face massive internal transitions? I'm Daniel, and welcome to Asian Money Map. On this channel, we explore the financial ecosystems and the business structures shaping the East, trying to understand where wealth is moving without the hype. If you find the reality of global economics as fascinating as I do, stick around, because understanding this changes how you look at the brands you use every day. To really grasp what we are talking about, we have to step back and look at the sheer scale of these businesses. It's easy to throw around the word conglomerate, but we need to understand what that actually looks like in practice. Let's look at South Korea. South Korea is a global powerhouse, famous for its cultural exports, its technology, and its automotive industry. But the South Korean economy is largely defined by a unique business structure known as the chaebol. A chaebol is a large industrial conglomerate that is run and controlled by an individual or a family. The most famous of these, of course, is Samsung. Now, in North America or Europe, you probably know Samsung for their Galaxy smartphones, their televisions, or maybe their kitchen appliances. But inside South Korea, Samsung's presence is vast and deeply integrated into the infrastructure of the country itself. They are involved in heavy industries. They build massive oil tankers and cargo ships. They operate one of the largest life insurance companies in the country. They have a massive construction arm. In fact, Samsung C&T was one of the primary contractors that built the Burj Khalifa in Dubai, the tallest building in the world. They even operate theme parks and fashion brands. When you add up the revenue of all the different companies sitting under the Samsung umbrella, it is equivalent to roughly 20% of South Korea's entire gross domestic product. We really need to pause and think about that number. One single family network overseeing a web of businesses whose revenues equal 1/5 of a G20 nation's economic output. It is a level of concentration that is historically incredibly rare. And this model is not unique to South Korea. If we look across the map to India, you see Reliance Industries controlled by the Ambani family, which has a massive footprint in energy, petrochemicals, retail, and telecommunications. If you look at Southeast Asia, the patterns repeat. In Thailand, the Cheravanant family's CP Group is a titan in agriculture, retail, and telecommunications. In the Philippines, the Tsai family's SM Investments operates heavily in retail, banking, and property development. These groups don't just operate within the economy. In many ways, they are the economic infrastructure. But that brings us to a really interesting question. Why did this happen here? Why did the family-controlled conglomerate become the dominant species of business in Asia, whereas in the West, we saw the rise of the widely held, publicly traded corporation, where the founders eventually stepped away? To understand this fairly, without just pointing fingers at monopolies, we have to look at history. We have to look at the environment in which these businesses were born. In the mid-20th century, many Asian economies were rapidly developing. They were navigating post-war reconstruction, emerging from colonial rule, or going through massive political transitions. In a developing economy, the institutions that Western businesses take for granted often simply didn't exist or were very fragile. If you were trying to build a business in the 1950s or 60s in these regions, the legal systems might have been slow or unpredictable. Property rights could be uncertain. You couldn't necessarily rely on a formal banking sector to give you a loan based on a business plan. And you couldn't rely on a court of law to quickly enforce a breached contract. The environment was highly volatile. So, in the absence of strong institutional trust, what do you rely on? You rely on interpersonal trust. You rely on your family. This necessity helped solidify what researchers often call the bamboo network, particularly among overseas Chinese business communities across Southeast Asia. Business was conducted based on deep, complex networks of relationships, trust, and mutual obligation, often referred to as guanxi. Deals weren't always struck by armies of corporate lawyers drafting thousand-page documents. They were often built on a handshake, a shared heritage, and the understanding that your family's reputation was on the line. This structure actually provided a massive competitive advantage during the high-growth years. Speed. Imagine a Western multinational trying to enter an emerging market. They have to do feasibility studies, consult their legal teams, hold board meetings, and answer to shareholders who want to see a return next quarter. By contrast, the patriarch of an Asian family conglomerate could sit at the head of a dinner table, hear about an opportunity in a new sector, say a government initiative to build new ports, and make a unilateral decision that very night. By the next morning, capital was being redirected and ground was being broken. This agility allowed these family groups to expand across multiple, seemingly unrelated industries very quickly, capturing market share as their host nations grew. But as these companies grew into multi-billion-dollar empires, they faced a new challenge. How do you raise the massive amounts of capital needed to compete globally without selling off so much of your company that your family loses control? The solution they found is a fascinating, though often criticized, financial mechanism. It's called circular cross-shareholding. Instead of a simple structure where the family owns one main company, they create a complex web. The family might own a holding company. That holding company owns 30% of Company A. Company A owns 30% of Company B. Company B owns 30% of Company C. And then, crucially, Company C might own a small percentage back in the original holding company, or in Company A. To an outside investor or an auditor, this looks like a maze. But the math behind it is incredibly effective for maintaining control. Because the companies own shares in each other, the family can essentially use the capital of the public companies they control to maintain their voting power. They might only own 5 or 10% of the total actual equity across the whole group. But because of how the voting rights are stacked and interlocked, they have the ultimate say. It acts as an impenetrable shield against hostile takeovers from foreign competitors, keeping the decision-making power firmly at the family dinner table. Now, looking at this objectively, we can see how this structure created the foundation for massive, rapid industrialization. These families took huge risks when no one else would, and they built the roads, the telecom networks, and the supply chains that lifted millions of people into the middle class. But we also have to be honest about the vulnerabilities of this system, because there is a very human flaw built into the foundation of every family empire. There is a well-known proverb across many cultures in Asia that translates roughly to, "Wealth does not pass 3 generations." The idea is that the first generation, the founder, builds the empire through immense struggle and survival instincts. The second generation, who watched their parents work, scales and expands the business using their elite education. But the third generation, born entirely into immense wealth and privilege, often lacks that original hunger, or they have completely different visions for the future, leading to the empire's decline. The greatest risk to these Asian economic engines today is not necessarily foreign competition or changing consumer habits. It is succession. When a patriarch passes away, it is not just a corporate transition. It is the transition of a dynasty, and when succession planning is unclear, things can get incredibly destructive. Let's look at a factual case study to see how this plays out, and this is where I need to correct a common misconception you might see online. Let's look at the Ambani family in India. The legendary founder Dhirubhai Ambani built Reliance from a small trading firm into a massive petrochemical and industrial giant. But when he passed away in 2002, he did not leave a will. This sparked a highly public and intense conflict between his 2 sons, Mukesh and Anil Ambani. The uncertainty paralyzed decision-making and actually caused ripples of anxiety throughout the Indian stock markets, because Reliance was such a significant part of the national economy. Eventually, in 2005, their mother had to step in and broker a demerger, physically splitting the empire. Now, a lot of people think Mukesh just took everything successful from the start. That's not accurate. The split was actually quite distinct. Mukesh retained control of the core legacy businesses, the massive oil refineries and petrochemicals. Anil took control of the newer, fast-growing sectors, telecommunications, power generation, and financial services. For a while, both brothers were among the richest men in the world. But the story didn't end there. The businesses Anil inherited faced massive debt, heavy regulatory hurdles, and intense competition, leading to severe financial distress over the next decade. Meanwhile, Mukesh used the immense cash flow from his oil business to meticulously plan a return to the telecom sector, which he was legally allowed to do once a non-compete clause expired. He launched Reliance Jio in 2016, investing billions to build a 4G network from scratch, offering dirt-cheap data that revolutionized India's internet access, and in the process, severely outcompeted the legacy telecom players, including his brother's company. Today, Mukesh Ambani is the richest man in Asia, while Anil has faced a dramatic decline in wealth. This saga shows just how violently fortunes can shift when family dynamics intersect with massive corporate strategy. We see similar turbulence elsewhere. Look at the Lotte Group, the massive conglomerate that operates across South Korea and Japan. A few years ago, they went through a bruising succession battle between the founders' two sons. It involved public accusations, boardroom coups, and a surreal moment where the nonagenarian founder was wheeled into a hotel office to yell at executives. When family leadership fractures like this, it's not just a tabloid story. It affects stock prices, it affects the job security of hundreds of thousands of employees, and crucially, it stalls innovation. And I want to offer a bit of analysis here, because this stalling of innovation is the most important part of the conversation today. As a financial observer, I look at these family structures and I see a massive double-edged sword. On one hand, family ownership allows for long-term vision. A family doesn't have to panic if profits dip for 2 quarters because they are investing in a 10-year research project. Western CEOs, who often last only 3 to 5 years, simply cannot make those kinds of long-term bets without getting fired by activist investors. But on the flip side, these conglomerates can become deeply inefficient. In finance, there is a term called the conglomerate discount. This means that the stock market often values a sprawling conglomerate for less than the sum of its individual parts, simply because investors know that capital might not be allocated efficiently. A patriarch might take profits from a successful tech division and use them to prop up a failing shipping division just because he has a sentimental attachment to the ships. Furthermore, from a macroeconomic perspective, when 2 or 3 families control the entire supply chain, it creates incredibly high barriers to entry for anyone else. If you are a brilliant young entrepreneur with a great idea, it is very hard to build a startup when the dominant family controls the raw materials, the distribution logistics, and the retail shelves. You are either forced to sell to them, or they can simply price you out of the market. It's a valid concern regarding wealth inequality and market fairness that many policymakers in these countries are currently wrestling with. So, where does this leave us? Are these empires destined to collapse under the weight of the 3-generation curse? Not exactly, because the smartest of these families are adapting. And they are adapting by completely changing what a family business looks like. The 3rd and 4th generations are not necessarily interested in managing cement factories or supervising shipping ports. They have been educated at places like Stanford, Oxford, and Wharton. They understand global finance, artificial intelligence, and decentralized systems, and they are realizing that the best way to protect their family's wealth is not to run the legacy businesses directly, but to transition into massive, sophisticated family offices. Instead of fighting the agile, disruptive tech startups, they are taking the massive cash flows generated by their traditional businesses and using it to fund those startups. They are becoming venture capitalists. They are setting up discrete investment vehicles, often in global financial hubs like Singapore, Hong Kong, or London, to diversify their risk away from their home country's politics and currency. This is a massive shift. The modern Asian family empire is becoming less visible, but actually much more influential globally. When you download a new AI app, or look at a breakthrough in biotech in Europe, or see a new green energy initiative in North America, There is a very real chance that the seed funding for that innovation was provided by the great-grandchild of someone who started out selling textiles or trading commodities in a small shop in Mumbai or Seoul 70 years ago. They are moving from being the operators of the economy to being the silent financiers of the future. The era of the heavily industrialized, highly visible family monopoly might be entering its twilight, but the era of the sophisticated, borderless family investment empire is just beginning. They are ensuring that no matter how technology disrupts the market, their capital is positioned on the winning side. I find this evolution incredibly compelling because it bridges traditional history with modern global finance. But this brings up a really important debate, and I want to turn this over to you. Looking at the facts we've discussed today, the rapid growth they provided versus the market dominance they hold, do you believe these massive family conglomerates are ultimately a net positive for their country's economic development? Or do you think they are now stifling the next generation of independent entrepreneurs? Let me know your honest analysis in the comments below. I read every single perspective. And if you enjoyed this breakdown and want to keep mapping out the realities of global wealth and the hidden structures of business, make sure to hit that subscribe button so you don't miss our next deep dive. Remember, when you are looking at the economies of the East, business is rarely just business, it's always personal.